Good morning. Welcome back to the Relay by DePIN Digest. We are here to talk about, is DePIN an RWA? It's a big question. We brought some specialists on today to talk about it. We have Bradley Meyer from DePIN Connection. He's a powerhouse in the DePIN space. You guys probably already know him. And we have Ray Buckton from Two Bucks Media. He is an RWA specialist. So we're kind of trying to push the envelope of the conversation to figure out exactly what an RWA is. That's why we brought Ray on. I'm joined, of course, by my co-host Will, and I am Matthew Bucklead. So let's just dive right in, guys. So I'm kind of curious. I sort of want to start off with helium because that's sort of the biggest DePIN device example that I can come up with. It's a physical device, has real revenue, and you have a real owner. So why isn't that an RWA?
It is quick, end of stream, conversation over. Joking. I'm curious as to Brad or Will's take on this because I have a little bit of a thesis, but you guys are closer to the DePIN fire. So like, would you guys do that as it's real?
I mean, it's if you want to get to the nitty gritty, it's a real world asset. I mean, it's tangible, right? You can hold on to it, and there's a tokenized representation of it on chain via an NFT. So technically, I would say if you're trying to get really really technical with it, it is, at least in my opinion. But I could probably put another perspective on it. But I want to hear Brad's take before I do.
I mean, I think it's a bit semantics, I guess, but
yeah.
Yeah. I mean, I guess RWA would be just tokenizing an asset. I think DePIN kind of takes it a step further in creating a two-sided marketplace in many cases and building out an actual business. I would say that there's a lot of overlap. If you look at something like Fractals, though, where they're actually created a marketplace where you can buy fractional ownership into a deployment for Helium, that kind of merges the two even more, I would say, and kind of brings a lot more overlap. But I don't know. I mean, I think you could, in some ways, use the two interchangeably. But I think with DePIN, you are not just tokenizing, a physical location, but you're then taking that to market. They partner with AT&T. They're creating revenue, as opposed to a traditional RWA, that you would think about in the form of real estate and tokenizing, property or something of that nature.
Yeah, I think the fractionalization point's huge too. What Brad said, I think that's where the convergence of the typical RWA thesis or mindset collides with DePIN, where RWA in the RWA space. I know Ray and I have been on spaces many times where people talk about fractionalization as a key benefit of tokenization. And I think that when you take that concept, put it on DePIN, you're able to fractionalize out these hardware devices that earn yield and get that yield to other people out there that might not necessarily have a direct stake in the device or maybe installed the device themselves. I think that's a really awesome way that RWA comes together with DePIN.
So I love that thesis. One of the kind of hills that I am dying on is that RWA is the worst acronym. When it first came out, I was like, RWA is Royal Writers Association out of Britain. I'm like, okay. And then find it indexed, and then it's well, what is a real world asset? Wait, what's a fake world asset? So I love both of these points here because it gets me thinking in the direction of it sounds like distribution is a component too. So I'd love to double click on kind of that topic because with a lot of RWAs, I see there's already almost a level of pre-existing distribution, at least from the financial mechanisms, right? So you have distribution for treasuries, good example, most liquid asset in the world. You also have it generally for private credit. Private credit is an existing kind of sector. With DePIN, it seems like there's not a lot of existing distribution. You also have to bootstrap that network along with kind of the token incentive model. So I'm curious how you guys are viewing that, because that's going into DePIN, I see a lot of things that rhyme, but there's different elements than what I see traditionally in financial RWA tokenization.
Yeah, I think that would probably be one of the biggest differentiators, is that a lot of DePIN networks are bootstrapping new devices or device deployments in locations. I mean, you have, with Helium, going back to that example, you can brownfield convert an existing network to just, hop onto the Helium network. But in a lot of cases, you're actually installing these devices in local businesses. So there is kind of a difference there in that you're not exclusively using those pre-existing assets.
I'm curious how you guys feel about the lock-in aspect. Because one of the things I've seen in RWA, from Web3 people specifically. Now, folk outside the industry, totally different ballgame. But is the speed at which they can disengage from a vault, right? So like private credit, I brought up. There's like a 4 to 7 year lockup term traditionally, which is like a huge amount of time. 4 years is like max bonding curve for like the curve, right? Which is the minimum end for private credit. How do you guys see the DePIN kind of lock-in situation? Because like I own like one DePIN device. I know Matt owns several. I know you guys do as well. So like, how do you guys view that as like a lock-in sort of thing? Because I almost see it seems to me from the outside, DePIN doesn't have as much of a distribution problem as RWA. You got a lot of people interested in these devices. Like, how do you guys view that?
So, go ahead, Brett. I don't want to cut you off. I was gonna...
No, I mean, are you talking about more so like the token unlock schedule and who the tokens are unlocked to, like the different parties?
I'm kind of thinking from the perspective of like almost like a sunk cost. Like once you own the device, you own the device. You know what I mean? When I deposit an RWA vault, I can take that money out, for example. Yeah. So that's the kind of a dynamic there.
Yeah, it is. I mean, with DePIN, it is certainly one of the problems, I would say, is the fact that you have that sunk cost up front. And then that creates a lot of sell pressure, because people have to recoup that cost. So I think that's one of the hurdles that they're trying to figure out, especially in the early stage of these projects. The other part is I think people have very unrealistic expectations on like how long it should take to recoup their costs. I mean, I think there is a dangerous precedent set in the last market cycle with helium where things got outrageously overvalued, and now people think that they should ROI in 1 week on hardware. It's just like that's what it is, man. And I think we need to have a little bit of a reset because those unrealistic expectations don't align with the long-term viability of these projects. I mean, you can't tell me like HiveMapper, when they had their Coinbase listing, got super overvalued, and people were literally breaking even on their dash cams in a week. And to me, like I had to kind of ask people, like, do you feel like you driving around for a week produced $550 worth of value? Probably not, so I think we need to kind of touch grass a little bit and come back down to earth and reset expectations on ROI. Now, I get from one perspective, like it's more risky than a traditional investment, but when you look at like TradFi, you're looking at multiple years for ROI, generally speaking.
Yep.
So I think there's just like this big disconnect. But to your point, though, I mean, yeah, when you invest in this hardware, that's why there's all this sell pressure up front. And that's why a lot of these projects that have had a lot of dilution early on are fighting an uphill battle now, because a lot of them didn't have revenue early on to offset that sell pressure. We're starting to see that shift a little bit. We're also seeing some interesting concepts to reduce that upfront cost. Like Rover's doing something very interesting where you can buy Rover tokens, you stake the tokens, they'll send you the hardware. You have to commit to mapping for a year with that hardware, and then when you send it back, you get your staked tokens back.
Interesting. Okay, so there is the financial mechanism there. This gets super interesting to me as a financial kind of RWA nerd. Will, the company you mentioned that allows you to like buy a sliver of an existing installed device, this is the first I'm hearing about that. That sounds super interesting because that, like I said, I got like one DePIN device. I don't want to go into the whole gamut of them. This is something I would use. So like, can you walk me through that? Because that sounds
So Brad and I are talking about fractals, where I think that's just one organization currently it's doing it, but there's a couple out there. There's also some infrastructure financing plays you can get into, which are technically kind of like fractionalization. But fractals is basically taking existing deployments. So if you were like, let's say you're a deployer, let's say you're like a mass enterprise deployer, and you're a guy that's bought like 100 helium devices, maybe you got some XNet devices too, and they're in very healthy locations. And what do I mean by healthy is, like there's lots of connections, lots of usage, lots of data flowing through, lots of revenue coming in on those devices. If you wanted to pull the capital out of those devices, because you have capital locked into it, of course, like you said, locked in, If you wanted to maybe get some capital up front, get some earnings up front for cash needs in the immediate future, you could take those future revenue, the future revenues of the device, and basically fractionalize those. You can give those out to people that can then buy into the device and say, hey, we want to buy a portion of the revenue, the projected revenue of this device. Here's some capital up front. Here's some cash up front. And me as a deployer, I get access to that cash immediately. I can then redeploy that into my business, as opposed to waiting on the capital to come. And then those people that want to get access to those yields on their cash can do so through fractionalization. That's pretty much what Fractals does.
There's another layer to this they're introducing as well, that if you, let's say you buy a shard, so they've fractionalized a deployment basically on their website. Let's use Helium as an example. They give you an estimation on how much HNT that thing's going to produce a month or every 2 weeks. They sell 50 shards, so you can buy fractional ownership into that. There's like secondary markets that you can then resell those shards. So like, let's say that, you buy in the bear market and the market takes off, all of a sudden that shard is yielding a much better return. You can then play the market conditions and sell that if you think it's overheated, and actually monetize it that way as well. So it's super interesting.
It's basically a bond at that point, Brad.
Price
goes up, yield goes down.
Do these shards represent like what, like helium, like not like say helium specifically, but is like one shard for helium, another shard for rover, or can one shard represent like multiple? Because exactly, you said, well, that sounds like a bond and a financial engineering mechanism, which this is the first time hearing about that. That's cool.
Currently, it's per deployment, Ray. So, like, you go on their site, you can see the deployment and see the location and see the earnings. And then, once the sale goes live, you can then buy into it. And then when the sale's over, that's pretty much it there. But they're adding that secondary market where you can trade shards with people and basically trade those claims.
Bundling would be super sexy too. I'd love the idea of bundling up some shards and being like, hey, this is almost like a proto ETF, because then you can bake that into like an RWA vault. And that makes sense for me. Institutions being like, oh yeah, I want to invest in physical hardware deployment. How do I do that? It's like, oh, here's
and on the RWA front too, Ray, I wanted to bring up USD AI. I don't know if you've ever heard of them, but essentially they have stable coins that you can purchase. You can USD AI token. You can go 1-to-1 with the dollar. It's backed by treasuries and dollars, but you can then stake that token and get GPU yield. So like basically you can fund GPU like farms, these massive GPU infrastructures for AI, and the yield generated from those GPUs plus the interest on the debt that the company used to build the GPUs with will then go to you who you're staking your dollars. So you can get like 15% yields, 20% yields, which is very similar to what Fractals is doing, just albeit different on scale, of course. But
yeah, and Fractals has been doing that for what, GeoDNet, XNet, Helium. It kind of reminds me of what Peak has done with the tokenized robo farm. It's almost fully automated, or it is fully automated, and they just paid out the first yields. I think it was a few thousand, 2,000 or 3,000 USDC to the tokenized holders of those.
And when you say robo farm, I know this isn't how it works, but I imagine just like huge cornfields, and there's like Bender from Futurama out there, just like, this sucks, I hate this. Like, what is, when you say robo farm, is this the GPU component you're talking about?
The farms have overalls on. The robot farmers have overalls on and straw hats on.
And
they're complaining. They're complaining about their wages. Of course.
Don't forget the pitchforks.
Yeah, mine were. The ones I saw were complaining, but then they started saying token overflow error and just repeating that over and over.
Yeah.
But the technology is getting there, but I love this direction just because this it naturally kind of folds into like more the financial engineering aspect. And that's like the genesis of the thesis statement. Like, is DePIN RWA? Are these terms even useful to distinguish? Because I'm curious as to the conversations y'all are having. Because like I'm kind of in a bit of like the ivory tower isn't the right term, but like the financial kind of like wing of the world. Right? I talk to a lot of Wall Street folk, so we talk the same language. When you put this stuff outside of the financial plumbing, it's like, well, this is Greek to me. So you're tokenizing a treasury bill versus a bond. I didn't know there was a difference. How are the conversations going with you guys when you bring up DePIN and like hardware to folks outside of our industry? Are you seeing it kind of grok a little bit more readily just because there's a physical hardware layer, or just how are those conversations unfolding?
Well, I think you're dealing with like definitely a different type of person than we are, for sure. For us, as far as deployers go, and Will can probably speak on, well, both Brad and Will could speak on this a lot more extensively because I'm relatively new to the deployment game. You're looking to solve a real world problem that a business has, or provide them the opportunity in the XNet or Helium's case to gain yield from their real estate, so to speak, by improving connectivity. So I think you're dealing with a different type of person who, local business owner who may want a little bit of extra cash or to just improve their connectivity for their customers, compared to you're dealing with financial instruments and tokenizing equities, which is a totally different class of person, I would say. They might be involved in both things, but it's certainly different.
Yeah, you hit the nail on the head there, Matt. I mean, the thing I noticed when talking with people about installing a hotspot or installing a piece of a device in their business is, I mean, they're mainly open to it. I mean, hell, even yesterday, if you talk to someone, which I was talking to this gym owner about GPU farming, pretty much, just random topic came up. He was talking about like creating his own AI. It got kind of crazy, but anyways, I mentioned like, oh, so like, would you be open to like installing like an antenna on your roof and like earning some yield on that? And he's like, oh yeah, for sure. Like, it's just like, it's about the way you present the idea and present the the amount of effort that goes into putting something like this up and the capital. Obviously ROI is important there, but I think when you kind of are upfront with like, hey, we're going to deploy, X device inside your business, it's going to do, Y service for you, and then there's some yield attached to that. I think people, just kind of they attach that idea very well, at least in my experience. But Brad, I'll throw it to you.
Yeah, I think it depends on the context, right? I mean, if I'm building out, like I built out a Hive Mapper fleet of 100 Uber and Lyft drivers in the early stages of Hive Mapper, it was also right after FTX, right? So you got to put your sales hat on. I spent like 15 years in sales, and a lot of that time in sales training. So I, in many cases, explained the use case, explained the problem that was being solved, what the benefit was to the driver without bringing up crypto. Because for a period of time there, like bringing up crypto is like a non-starter for anyone. And I think we're kind of in that situation to an extent right now, honestly, because you look at like the Coinbase ad at the Super Bowl. I mean, people's responses to that, I think after like the meme coin stuff, now crypto's so politicized, like you have to be really careful about the wording you use. But that's one of the good things about DePIN is like these are real businesses solving real world problems. So the use case makes sense to people. So from that perspective, I tend to focus more on the use case because that connects with people and their benefit for participating. If it's like my channel and I know it's like crypto-minded people coming to the channel, then it's about more educational and breaking down. I really break things down in like 4 different subsections, I suppose. Like number 1 is what's the use case, then total addressable market. What's the path to participation? What's that cost? What does that look like for you on a day-to-day basis? What does the team look like? And then what are the tokenomics look like? And I think those are like the 4 main categories. So again, like depending on the context, is it a crypto-minded person already or not? And I think you have to consider what state the general public is in as far as like how they're looking at crypto, because it shifts very quickly. Yeah.
It's funny too. Like sometimes you'll run into people too, Ray. Like my very first deployment I ever did was at my favorite sushi restaurant in town. Like I go there all the time. I've talked to the owner and his wife multiple times. Like I love that place. It's always slammed full of people on their cell phones waiting for a hibachi table. Like they're always waiting for a hibachi table to be ready. So I figured it'd be a perfect place to put a Helium hotspot. And sure enough, it was. I mean, it generates really good revenue. But I remember talking to him. I was like, hey, like, would you be open to, partnering up? I install this and you literally don't do anything different. I just give you a monthly paycheck. And he's just like, oh, sure. Is this like a crypto thing? That's like the first thing he said. And I was like, he's like, yeah, Helium. I've seen that before. H&T token, right? And I was like, oh, he knows. I was like, I was like, oh, so you have Coinbase? He's like, oh yeah, I got a Coinbase account. I do some crypto trading sometimes. I'm like, oh yeah, well, I'll just pay you in H&T then. He's like, that's perfect, dude. Yeah, I don't mind. And I was like, sick. That went way easier than I thought it was going to.
That was the thing that really got me like hooked on DePIN initially. It's because you're deploying the infrastructure that people don't necessarily have to look under the hood to understand. They just know it works. And that's like, it's the culmination of like actually employing and implementing the technologies that we've we've been following for years now, and you have the on the ground results for just everyday people, but then you have people like Will was just talking about, who they already know crypto, they're with it, and so they're a much easier sale.
He was more like on board with the fact that he didn't have to do anything extra. He was like, so wait, I don't have to do anything different? Like, nothing changes with my business? And I was like, no, I handle everything. He's like, okay, cool. I don't care. Do whatever you want. It's like, sick.
And the bullish on crypto angle is helpful. I'm really curious because like it reflects what I've kind of seen in RWA and like TradFi as well. Is like, asset tokenization, on-chain finance. Ooh, we love this. Web3. Okay, crypto. No, get that away from here. We don't want that at all. So many people have been burned by it. I think it kind of tethers back really nicely, Brad, to something you brought up, which is the ROI expectation. Even paying off a device like a 6 month to 1 year time frame is really solid, because anything after the fact, you're just printing money basically. Less electricity costs. But realistically, it's not like Bitcoin where it's going to have dynamic difficulty adjustments. I think we're bumping up against that in RWA as well. We see a lot of vaults where we end up in a situation where it's like, hey, you can get 12, 15, 18% APY. And that's something that Web3 folk are like, it's nothing. Why do I care about that? But it's actually really significant if you're putting in $1 million, $2 million, $10 million. So I think there's like a size issue in terms of allocation, which may not be
always a size issue, Ray. Always a size issue.
I told you not to bring that up, Will, in the conversation. Right, hurts my feelings, man. But no, yeah, it is a size allocation issue, which there's unfortunately no pills for the size allocation issue. With that said, I gotcha. Wait until you take the drink of coffee. For folks at home, Will and I have a lovely dynamic. We've only been doing spaces together for...
This is our first time meeting. What are you talking about, Ray?
I've never seen you before in my life. I have no idea who this person is. But with that said, we obviously don't have a relationship size issue. Love you, bro. But the allocation size issue, I'm curious about DePIN, because I keep hearing Masari saying like, hey, DePIN's the frontier, but also there seems to be like a bit of a gap where the crypto bros have come in. They expect super large, very fast ROI. How do you guys view the kind of cultural pivot? Because I'm seeing that in RWA too, where we're at a crossroads in terms of culture. Native on-chain folk want it one way, TradFi wants it another way. Are you guys seeing the same thing from people who, like Will, you just mentioned you had like the hybrid almost, and the hibachi owner where he's like, I'm in the crypto, also real world business, viable for deployment. Kick it over to Matt. Matt, what have you seen out there? I know you've been talking to some folk in your local area.
Well, I was actually going to say, I think Brad might be one of the best people to ask about this, because we're sort of building through the bear market, so to speak.
Yeah, look, this is a really good question, because I've interviewed like several different founders over the last few weeks of different DePIN projects, and I think there's a shift taking place. I think if you look at the last market cycle and even earlier in this market cycle, there are still a lot of DePIN projects, the BS ones, which, I mean, I think the vast majority of the projects that popped up aren't going to make it, and some have already failed. I think they were looking at riding up the hype, attaching a product or an idea to a token, hoping that it would surge up and they would just be able to cash out at the height of the market, as opposed to building up something that has, long-term viability. So I think there is a bit of a shift taking place in us, the real builders wanting to actually build something real. But also, I'm hearing more and more from project founders about how difficult it is to build in this space. And I think some of them are trying to hedge a bit, right? You're seeing this in some cases, like 375 AI. They are building out deployments on billboards that don't require the participation of the, I say fickle because it's true, the fickle DePIN community that wants a 1 week ROI. You see HiveMapper has started going after for a while ago. They started going after like real businesses and fleets at real businesses, and with an attempt to build out tools that they could use where the token rewards are secondary, if important at all. Some of them don't care about the token rewards, but that way you can protect against the fickle DePIN community that, again, wants to make $2,000 a month on a freaking dash cam. That way, you still have consistent data coming in, because that's the big problem, right? You have these booms where all of a sudden 50,000 orders come in for your hardware with the unrealistic expectations. And then, of course, we have the market pull back, and those people now, all they do is complain all day and don't want to go out and map anymore. And navigating that is hard enough. You're running a startup as it is, and you're trying to build a viable product, go to market with that, find companies to buy this product while you're a crypto-based company, and now you have inconsistent supply of data. So to your point, I think a lot of these projects are looking to hedge to an extent to try to smooth out that supply side. And I think that's going to be a healthy thing for the space. And yeah, the crypto bros, like, look, man, they're your best friend when the market's up, but when the market's down, I mean, our buddy Quez can testify to this. Like, he is the community manager for 375 AI, and all the people do is go into Discord and complain now. And that's like all the projects, man. It can be exhausting. So it can be a huge distraction for builders as well. You know, one other thing, I interviewed the founder of Akash Network yesterday, and he was talking about how they are running hackathons in San Francisco right now, and for people like AI agents for builders to come in. And he's like, this is the most electric thing I've felt in a long time. It reminds me of the early days of crypto. He said that like their last hackathon was at capacity and had 200 people out the door waiting to get in. Yeah, and like there's people like Ashton Kutcher and like these celebrities are showing up to these hackathons because it's like super exciting. He's like, it's very organic, as opposed to, you know, some of the recent crypto, you know, now that we have institutional interest and everything into crypto, he's like, now all the, you know, the more recent events, it's been talks about DATs and talks about, you know, the finance side. He's like, the true builders, you know, that excitement, he's like, we're seeing it again in certain respects, and it's very organic. And I think that's super exciting to kind of get back to the roots a bit, but also see this maturation process that's taking place in DePIN. And I think that the real businesses are going to shine, man. We're starting to see that already. But I do think a lot of it comes back to, unfortunately, some of the unrealistic expectations that were set. And I hope that, you know, some of those participants get washed out and we have more TradFi-minded people come in and invest in these projects.
Yeah, man, when you mentioned $550 a week, I came from a trucking background, and that's like half of what a lot of truck drivers make in a week. And they're hauling like tens of thousands of pounds of freight every single day. So I don't think, you know, just driving around your local town for, you know, 30 hours a week is really providing that much value as far as the mapping data goes. But I think that what you were talking about as far as the, you know, kind of going back to the roots and the foundation, this whole, you know, DePIN space, it's still kind of an experiment in a lot of ways. You know, we talked about that on a space a few weeks back that, you know, Helium really pioneered this space to a large degree, and we're still in the early stages. You know, a lot of these companies or a lot of these projects, they default to the buyback and burn model, which again, we've kind of had discussions about as far as the benefits and drawbacks of that, to sort of not classify as a financial instrument or a security. And so that the actual usage or use value and the utility of the token is sometimes kind of difficult to iron out. But I think that's just really important. I just kind of wanted to mention that for our audience, is that DePIN is a very new thing, even still now. And we're still kind of ironing out a lot of these kinks, especially as regulations come forward and as these projects kind of mature, they reach product market fit. So there's a lot to consider here, but yeah, don't expect a 1 week return on a device.
One thing I want to underline, something that you mentioned in a term that you use that I've been kind of just crusading against is projects. And I think it's a cultural thing in Web3 is we call them projects. These are companies. And expecting a VC to put in $2.5 million into a project and treating it as such, never a good recipe. It's only in Web3 that we've seen that happen. And I think to Brad's point, the community chaos, I tell our folks in RWA that all the time that I'm advising. I'm like, hey, you can take this approach and you can launch a token. One, make sure that you're regulatory compliant every aspect, but keep in mind, is it the right time? Because if not, exactly what you outlined, Brad, you're creating 6 full-time jobs with 1,000 people who are very angry at you that they didn't get rich suddenly.
Yeah.
And so is it a community or is it?
Also, do you need a token, right? Like, you have to ask yourself that, right? Too. Like, do you even need a token? But Brad, go ahead. I know you're itching to get in here.
No, that's a good question. Do you need a token? I know there's like a lot of talk recently about like oh, just do stablecoin payouts from day one. I mean, that in theory, great, but you have to realize like the token aspect of DePIN is a way to kind of bootstrap your network without using investor funds to do so. And the promise there, of course, is that you have the fundamentals and future revenue tied to the token to support that token price. We haven't seen that with every project. That's I think the key part that's getting figured out right now. So do you need to have a token? I mean, if you don't have a token, then let's say you raised $5 million for investment. It takes time to spin up that network and turn on revenue. So you're bleeding out of that capital you raised, as opposed to being able to create tokens that you can now use that capital in other ways to build up your project. And that token is kind of working alongside that with the future promise, again, that as you build out your network and revenue comes, there's a merging where that value flows into the token at some point. So, that money's coming from somewhere, right? It is my main takeaway. So, maybe over time, like there's a gradual process where I guess you can phase out a token, but then what does that mean for the early token holders? That's something that still has to get figured out. But in my opinion, I think most DePIN projects, like in the early stages especially, do need a token unless you're willing to spend that investor capital. And then, it's a whole different conversation with your investors. A lot of these investors coming in, they have the understanding that, okay, there is going to be a token that we can obviously benefit from as well. But this money we're investing in you can go into growth. You have this token to bootstrap your network. That changes the equation a bit as well.
Well, yeah, if you don't have the revenue up front too, Brad, like you said, you got to pull into those, dig into those investor funds or the VC funds that you've built up. But also, I would argue with the token, you have that speculative upside too, like you talked about. Like you're taking on a lot more risk, as a deployer. But because you're taking on more risk, you're going to inherently, hopefully get more reward down the road holding these tokens, betting on the upside value of the tokens at some point, right? So without those tokens, you do lose that upside effect where it's like, I mean, maybe you earn more yield, more revenue over time as the network earns more revenue, but you're losing that inherent 5x, 10x that you might have gotten on your investment just holding those tokens.
There's a philosophical challenge here because I want to reframe a little bit because I think to your point, Will, I think DePIN kind of needs a token to bootstrap that network effect because you can offer, we'll give you this device for free, install it. Why? What is this? What's going on? So it does create that network effect. But I kind of want to reframe as can you do it without basically violating securities laws? Because in my mind, having let's say data distribution, you have data partnerships, you're bringing in revenue. Buyback and burn is interesting, but just because something is deflationary doesn't intrinsically make it valuable. How do you guys feel about a USD payout? Because that could come with the Clarity Act. They're making potential carve-outs for DePIN. From an outsider perspective, it seems like that is not a silver bullet, but it's definitely shiny enough to fix maybe the incentive matrix.
I'm more. So I think the Clarity Act will be interesting to see. Okay, are token holders now going to get the rights of someone that owns equity in, like you would in traditional stock, right? Because you don't have the same investor protections with, having a DePIN token. But I think the open market buys are the most important aspect. I am not convinced at this point that the burns have any material impact on the value of the token, full stop, because we've seen projects burn tokens, and especially if it's out of a treasury, it's a psychological smoke and mirrors part of the equation in my opinion. The open market buys mathematically makes a difference. You're all of a sudden, there's been this talk in DePIN about this perpetual motion machine. I think that's true if you're just burning tokens out of a treasury. If you're doing open market buys with revenue, that breaks that whole concept because now you're having external input. So let's say you're a DePIN project that has Web2 customers. If all of a sudden you're bringing revenue from Web2 customers into the ecosystem to buy tokens in the open market, again, that is now supporting the token price, and that breaks that perpetual motion concept that people keep talking about. So I think the open market buys are an absolute necessity. Now, as far as the burn aspect, I'm open for ideas around this because it is essentially throwing tokens into a black hole. If you can if you can think of a way to use those tokens for future growth, and some ideas would be, let's say the contributors are staking their tokens, maybe it could be somewhat of a dividend yield down the road to entice people not to sell their tokens, and to, the benefit of the community members that are participating and showing that, they're committed to the project. There are ways that I think those tokens can be used better potentially down the road when the project's more mature. Even if that means those tokens are sold at some point down the road, I think that selling pressure can be absorbed a lot better after there's more revenue, after it's a more mature project than in the early stages. So I've kind of come around on this, but I think the open market buys are absolutely necessary. And any project that's doing burns from a treasury, I have zero interest in holding their token ever again.
Even if they're doing open market buys, though, let me play a little bit of half devil's advocate, half like genuine from a financial background. Realistically, if you're doing open market buys, aren't you just doing basically for fast actors a financial distribution, essentially? Because if I'm a fast actor and I see you're doing this market buy, I can sell into that upward pressure. So you're kind of punishing slower actors who are maybe not actively monitoring the chart consistently.
Well,
again, with respect to the fact that securities laws, it's kind of a...
Yeah, so like GeoNet's doing something to kind of get around that, because to your point, if every Monday morning they're doing a buy every week, like you can play that. So GeoNet's doing regular buys throughout the day, small buy orders, so that there's no spikes in the chart from those purchases, so it's like smoothed out, right? So I think it's really important to do that, so you're not able to play that volatility, if you will. So I think that's an important part as well to bring up. Because we have seen that before. People know, like, on this specific day, or if you can play too, like, that High Mappers token rewards are going out on a specific day. You can kind of play that volatility as well. So I think it is important to do it in a way that people can't game it. But I do think the open market buys, in my opinion, is the one way to connect the fundamentals to the token price. And if you're not doing that, it's a glorified meme coin. I mean, you're running a business over here and it's great. You have all this revenue coming in, you have these customer announcements, but if the token holders are just sitting there, it's like, well, how come none of that's supporting the token price? Why would you hold a token? And I think that's what we're finding now. So I'm excited. I think this year we're going to see in the next year or two, I think we'll see there's a lot of smart people in the space that are coming up with new ideas. And to me, it's just the answer has to be the token is supported by the fundamentals, and give people contributors a reason to want to hold your token, as opposed to selling it as soon as they get it. Because if you look at a lot of the charts, the early stage DePIN projects, especially, you see spikes just like every other chart in crypto. There's no decoupling. I think GeoNet, because of their tokenomics, we're seeing some decoupling, which is what we need to see if we want this, this sector to thrive. And one last thing before I stop my rant, I would like to see the team unlocks, tied to milestones. These unlocks where it's just a set time frame, and you notice that a lot of them were timed for when the expectation at the top of the market cycle was going to be, that they could just unload their tokens. That needs to stop. We need to see that, if we're, a lot of times, we as contributors, sometimes the reward system is based on us bringing value to the network. I think they need to be held accountable as well. And I don't know if that's revenue metrics or whatever it may be, but I think there has to be milestones that they can get unlocks that they are also held accountable.
100%. Well, one thing, anything that starts in this industry needs is like clear corporate governance. That's one thing I'm really stoked about from the RWA side. Coming from TradFi, everything is very much like cut, dry by the book. So it's really interesting you bring that up, Brad, the notion that is still a thing where it's like, hey, we have a 2-year vest, boom, 2 years, cool. Good to see you guys. I'm happy to announce my new project, and that cycle continues. I'm curious, Matt, what do you make of all this? What's your temperature check on the market buy burn scenario, naturally, with market buy potentially having a little more salience?
Yeah, we've had some conversations on some X Spaces over the last several months, probably even much longer than that, about the efficacy of buyback and burn specifically. To Brad's point, just taking those tokens out of existence just creates scarcity, but scarcity doesn't necessarily drive value in and of itself. And so one of the hardest problems to solve, I think, in DePIN has been for the longest time. I'm sort of just repeating what Brad said here is the utility. I mean, you have to find a way that these tokens will provide utility for the holders so that they don't just immediately dump as they get them. And I think you have a lot of different participants in the DePIN space, especially when it comes to tokens. You have the speculators, you know, the crypto bros who want to buy on these early projects and get their 400x and then, you know, retire to wherever. And then you have the actual deployers, depending on the project, that are actually purchasing these devices and deploying them in proper locations, helping to build out the network, and they're being proportionally rewarded for those deployments. And then, of course, you have the team members and whatnot. And so it's a very difficult problem to solve. I think the open market buys, it has clearly worked for GeoDNet. Brad's example it's kind of the golden example for DePIN buybacks, is that they've been consistently purchasing, and I think is it 80%, Brad, of their revenue?
80%, yeah.
80% of the revenue goes back to purchasing tokens. So it's a massive chunk, and they've been, I think they were at 7 million ARR a few months ago, so it's probably much higher now.
Yeah, it's projected to go up. I think to like 10 million or 12 this year,
which is awesome. I mean, so all of that money is going, or a significant chunk of that money is going back to purchasing these tokens from the open market. And so there is that kind of upward pressure, and there's an incentive for these deployers to keep the tokens kind of in the longer term, because presumably the price is going to kind of increase over time. But it does kind of create some problems in that way. So I'm not a tokenomics expert, but that's sort of just my thoughts on the situation.
Fed Governor Matt over here.
Yeah, there you go.
That's also one thing I think that's worth. Like two things you said. The burns, you said it's like it's perception. It's all about perception, right? If people don't think that that's valuable, the scarcity is if the people don't perceive that as valuable, it doesn't make a difference. The scarcity aspect people have to care about it. You know, like eventually, mathematically, sure, there's less tokens to sell, but you know, GeoNet's at what, like nearly 3% of their total supply burn. Like, I don't know what that tipping point is where, you know, it actually matters, but for the vast majority of the time of these burns, it's going to be perception. If people don't perceive it as, you know, a value add, then it doesn't matter.
Yeah.
The other thing is, like, the 80% burns is very aggressive. This is something else that I've kind of, and 80% of revenue going to open market buys too, right? That's something I've also come around on, because, you know, that would be like a startup, you know, buying back equity right off the bat, which is not necessarily a great idea, because that revenue, especially in the early stages, can maybe be better used for growth as opposed to buying tokens. So something else I think we would be interesting to see is tokenomics, where there are certain milestones. So in the early stages, a lot of that, much higher percentage of that revenue is going into reinvesting. If it was on chain, that'd be great, so that people have visibility into what that money is being used for. But then as your revenue grows and you hit certain milestones, a higher percentage of that revenue goes to open market buys over time. You know, that way you're not like killing yourself in the early stages, because realistically, investors as well, if you're investing in a business, I think you would want to have the peace of mind knowing that revenue is going for growth early on. So I think that's something there. I think with the tokenomics, there's a lot of things to think through, and we're kind of figuring this out. I forget who it was. They're saying it's like building a plane while you're mid-flight.
Yeah,
you know,
that's a great analogy.
Yep.
I do want to reiterate what Ray said earlier about calling these companies projects. That is definitely something that we probably do need to kind of push forward as to our friends of the DePIN community, is especially the ones that have gotten product market fit, like HiveMapper, you know, GeoDNet, Helium. They're not projects anymore, and not even close. They're definitely real companies with real revenue. So that's. I also wanted to point out, we do have a commenter on YouTube. Let's see if I can show it here. Our boy Free Shkreli said, and GeoDNet is holding value compared to most other tokens. So the buybacks are certainly working, and the open market aspect of that, I think, to your point, Brad, is very, very important.
Well, even the like perception aspect too is so like what Brad was saying, like the narrative element there is very important. Like, that's why there's a consumer sentiment report that comes out. Like sentiment does matter. It seems arbitrary to a lot of people. Like it seems like this like very like whatever like ethereal thing. But it's a narrative is very important. That's why you like look at Bitcoin, for instance. Like Bitcoin's narrative as a store of value is in question right now. Like a lot of people are questioning it as a store of value, whereas like before that was the narrative, and like the price was pumping. Everyone's like, hell yeah, this is a store of value, deflationary, let's go. But now it's like kind of coming in the spotlight again because of other market dynamics maybe. But the narrative does matter. The story matters because those people holding GeoNet tokens are under the assumption, hey, these burns matter to me. And these burns show me that, this could see significant growth over the course of whatever time frame you want to put it in. And so now I am incentivized to hold said tokens just based on the sentiment, based on the perception that there is value being accrued there.
Yeah, and you made a really good point there as far as the perception. And Brad mentioned something just a minute ago in terms of the narrative. We do kind of work in a very short-term minded industry in especially on crypto Twitter, I should say. And so the long-term kind of long time horizon concept of deploying these devices as far as DePIN goes, or making these investments for multiple years as far as RWA goes, it's kind of a difficult sell because people really, especially in the bull market, people are really interested in those 300x multiples in a week. So it's like, how much and when can we, create or load up our bags and moonshot.
Yeah, I was just going to mention a lot of this is the time preference of the investor as well. The notion that this 80% allocation to open market buys is something that is super crucial, which it can be. But like you mentioned, Brad, it's very aggressive. That tendentially would satisfy the folks like, hey, you're doing everything you can to make token go up. Whereas a longer term strategy likely may be better for growth. Counterintuitive sort of stuff like, hey, I want to raise $1 million for my company. VC comes and says you actually need 1.3 million because I'm not going to give you $1 million and you get 8 months in. You're scrambling to find a full-time job. I'd rather you do the full 18-month gamut and actually take a true shot to see if this works.
Yeah, it's a tough balance. It is a tough balance because you're weighing out how to make sure to balance the value of the token with the growth of your project. Dealing with people that are very short, have a very short time frame on their investment thesis, and I think over time, if you specify this thing, so Free Shkreli just said like, but what if that changes? What if enforcement is there to God, if you can pull it up from 80 to 0% because of some excuse from the company? So it's something that when I'm talking about a graduated burn is what I would call it. It has to be very specifically laid out. What are those milestones? Is it, hitting revenue metrics, things that can't be gamed either, in order to prevent, increasing your burns. I think, I agree. It has to be very specifically laid out. And I think there, if you have long-term commitment, you have unlocks for your founders, instead of like a, 1 year cliff with, 2-year vesting schedule. If you know that it's tied to certain metrics and can be drawn out a bit longer, I think you're going to attract longer minded investors into your project as opposed to people that are just trying to get rich real quick. So I think in implementing these things can also kind of bring in the community you're looking for that's more aligned with your vision versus just coming in to farm an airdrop, make money and leave.
Yeah, absolutely. And I want to point out that this has been a fantastic conversation. I really appreciate you guys all taking the time to be here. Thank you to our viewers. We've reached over 21,000 views on our broadcast here. So I want to kind of I'm on TV. I'd like to kind of go around our panel here just to offer some closing thoughts, some final thoughts. I would definitely love to have all of you back on here again here in the near future, because this is a great intersection, and I see how we can explore this a lot further for sure. So Ray, I'll toss it over to you.
Yeah, no, phenomenal conversation. Super appreciative of the opportunity. Always love chopping it up with you guys. You can tell Will and I, we have history. We got a little game show love connection going on. And, Brad, Matt, phenomenal hopping on with you guys. But yeah, I think we've concluded, is DePIN and RWA? Kind of, but like anything in this industry, it's an iceberg, right? It's easy to say yes, but there's, 90% of the material to be dug out underneath the depths of what we're still figuring out. So phenomenal opportunity. Appreciate you guys.
Yeah, well, hey, again, thanks for coming on. Brad, what do you think?
No, it's a great conversation. I think this is going to be we're seeing the maturation process of DePIN happen in front of our eyes, which is very exciting. And the real builders are going to continue building while the market's down. We'll see a lot of the pretenders and the frauds leave, which is great in my opinion. We need to see that. As far as RWA versus DePIN, yeah, I mean, look, there's a lot of overlap. I think, you can find similarities, but at the end of the day, I think it's semantics. The big thing for me is like, are these projects bringing real value? And are they solving real world problems? That's the thing that matters the most. And then as a token holder, is that being translated into the token price in some way, shape, or form? Like, it has to be supported. So we're seeing some projects do the right things. That's very exciting. GeoNet's one of those, I'd say. And as Free Skrelly said, good feedback loop for other projects to do the same as GeoNet. I think, Helium was a pioneer in the space. We always say they stepped on a lot of landmines on the way. They found product market fit. Some of their, early stage errors, in fairness, that they had to figure out for everyone else. I think they've got to work through that now. And I believe that they have an opportunity to do so. But for some of these other newer projects, I think they can get off on the right foot immediately, which is very exciting. I think we're starting to see it. So keep DePIN on your radar. Now's the time to be dialing in, guys. And I think there's some very bright times ahead.
Heck yeah.
Yeah,
Will?
I just great conversation all around. I mean, Ray and Brad are just gems to talk to all the time. I mean, just fabulous takes every single time, guys. Great conversation. I think the future is bright for both our industries, for the tokenization industry, the RWA industry, as well as the DePIN industry. I think that we've been through a lot, and because of that, we will get handsomely rewarded for sticking it out. I think, especially through the dark times. We'll find a way through. And just like Brad said, there's a lot of promising stuff coming out here. It's already happening. It's being built right now. The builders are still here. And to the hackathon point as well, like there's a lot of excitement stirring up underneath. So going to keep our eyes out for sure. Going to keep our eyes peeled. But yeah, great conversation. I'll throw it back to you, Matt. Yeah.
Well, and as our friends at Masari have been saying over the last few months, DePIN is the frontier. So some of the brush has been cleared. We've got a little dirt path that people can follow. It's not quite a full paved highway, but we're going to get there eventually. So be sure to follow the DePIN Digest on X and our other socials here on YouTube. We do these broadcasts regularly, every week, every other week. And please be sure to follow Ray Buckton and Bradley Meyer here, DePIN Connection, and Ray Buckton on X. They have raised the average IQ of the room since they joined, very high. So if you want to stay up to date with RWA and DePIN, how they intersect, and get on the forefront of the conversation, be sure to follow everybody and tune in next time. Thank you so much, guys, for joining us, and y'all have a wonderful afternoon.
Let's go.
Happy Valentine's Day. Don't tokenize and drive.